Okay guys, let's get into this trading example. We're going to be covering equity index futures. There was a opportunity where all four major markets that we look at in the futures markets and options as well lined up for a short opportunity. Things to keep in mind that all four of these major indices were hitting a level and creating the opportunity at the same time, which creates the confluence that we look for in our trades and our opportunities. We had a gap down that created the initial move lower, and that was all due to the weak market environment that we were in. So in this example, we're going to be covering what the rationale was, what we looked for, and what the charts looked like at that time. If you need any help, if you need to review back or go back to the course, review sections 1 and 3 of the Derivatives Day Trader course, if you need to refresh on any of the topics that we're going to be going over, any of the terms, any of the information that we're going to cover in this next slide. So let's get right into it. So the trade setup rationale in this example. We looked for price to retrace to the area near the gap down origin, so the origin of the gap down, which also was the regular trading hours high of the day at the time. Sellers came in and pushed prices down from that area previously. The first retracement back to the area of the drop was the opportunity we were looking for, a chance to join the move down. Markets tend to move in one direction, correct, and then continue their move. And that's the opportunity that we got here in this particular example. And you can see it on all four charts or four markets. There's 8 charts here, 4 markets. We have the futures up top, cash markets on the bottom. The size of the drop away from that price level showed us that there were sellers present. The gap told us that there were sellers present. So you have a gap down, and then you have a move lower off that gap down, and a first retracement back to that area where the market moved down was the opportunity. And again, it happened and appeared on all the equity indices, creating the confluence, both the cash and the futures markets. So let's get right into this. You can see that these are 15-minute charts. The markets were down quite a bit. So we had a weak market environment to begin with. So when you have a weak market environment, what we look for typically is retracements back up to an area where we can short. In a weak market environment, we expect the market to pull back or move lower. The highest probability trades in that type of market environment, a lot of the time, are going to be shorting opportunities after a rally back up in price. So you can see with the red arrows right in here, the market gapped down. We gapped down, rallied a little bit, tried to rally a little bit, could not, and proceeded to move lower. And you can see that play out on all of these charts. Now some rallied up a little further than others, but what we're looking for is the retracement back to those levels. We're looking for the entry once we get back up to this level. And you can see that in these areas where the red arrow is at. The blue boxes are going to basically tell us that there's a gap right here, just to highlight the fact that we have a gap, creating the weak market environment, meaning sellers were in control, there was a lack of buyers, and so again, the higher probability trades are waiting for a retracement back up in price to hop on board for a further move lower. You can see the gap down here on the YM, on the cash market, same with the Russell and the small caps right here, right here. Once we saw the market drop in this strong fashion, these moves down after attempting to rally, couldn't even fill the gap. These big strong moves down is what added to the conviction of the trade. We knew we were looking for a short because the market environment was giving us that, was telling us that. The market was telling us that there's further weakness that could come from this. A retest of the lows could come from this if we got an opportunity to sell back at the origin of the gap down. The origin of the gap down is right here. We gap down here, from here, set a high. This was the regular trading hours high of the day with an extended move down. So we basically had weakness, we paused, and further moved down. Our goal was simply to wait for prices to hold and rally back up to this point. It's one of our identifiers for an opportunity. One of the aspects, one of the inputs we look for a trading opportunity is paying attention to regular trading hours highs and lows, previous close, opens. We've gone over this multiple times in the course and in other videos. Price tends to move away from these levels, and that's why we pay attention to them. And so when you take into account a weak market environment, off of a gap down, a retest back up to the area where the market sold off after it attempted to rally is what created the opportunity. There was such a big imbalance in terms of the sellers versus the buyers that prices had to gap down. And so if we had a snapback up to that area where we saw the market basically come down in a strong fashion, 2690 down to 2670, it's a 20-point move here on the ES in this particular example. We're going to talk about the ES because we trade that mostly. But we wanted to highlight this example because it happened on all four major markets at the same time. And you can use that in your trading. So let's say you're trading, the ES. You can look at the other markets like the NASDAQ, the Russell, and the Dow to see where they're at and if they're approaching a level. A lot of the time, not all the time, but a lot of the time, these major equity indices will move with each other. Now there are times when there's disconnects and you see the NASDAQ rallying while small caps and the S&P are lagging and vice versa. But in this case, we had an overall weak market with a strong gap down, an attempt to rally, a failed attempt, a nice pullback, and then we got the retracement that we needed. There's plenty of profit potential on this trade, which was also a big factor for us. If you can define your risk and have a risk to reward ratio where your reward is going to be 2 or 3 times what the risk is, that's a great opportunity. And that's what we got in this particular example. These are the type of trades that we look for. Now, this doesn't happen all the time, but again, knowing what to do when the market is basically telling you what may happen next is the whole reasoning behind using price action, chart patterns, and candlesticks as our method of analysis. The market was weak. We saw that from the gap down. So that told us that the market was, in an area where sellers were in control, there was a lack of buyers. When we got a further move and extension away from that level in a strong fashion, that added to the confluence, that added to the conviction that if we got a retest back up in that area, that we'd have an opportunity. Now this is on a 15-minute chart. If you go down to a smaller time frame, there was possibilities and more aggressive ways where you can actually participate on the initial move down. Let's say this is on a 15-minute chart. These are all 15-minute charts. If you go down to, let's say, 5-minute or lower, you could have saw that the market was starting to reverse in this area. And so technically, there are a couple opportunities off these charts. Now, why would you take this move down and be looking for a further move down? Well, it just goes back to what we're talking about with the weak market environment. If you have a strong gap down, it's happening on all major equity indexes at the same time, and you see the market start to reverse with room to go. So there's white space down here. There's room for the market to go down. Hopping on board the initial move lower is not out of the realm of possibilities. It's going to be a little more aggressive of a trade, and you need to know what you're looking for, and that's where having some knowledge and experience with candlesticks and what the patterns look like and you know where a candle closes and opens is definitely going to help with that. And so, for our more aggressive traders, we were able to take not only this move, but also this move. The initial move in this screenshot was a little bit bigger than this retracement move, but the retracement is going to be a higher probability considering that we saw sellers already here present in the market. So hopefully that makes sense. Hopefully this trade example is helpful for you guys. Whether you're trading futures, commodities, options, stocks, you can apply the same principles to charting, to price action. If you're watching the markets, you see that we're in a weak market environment. You see that we gap down. You see that the markets retrace back up higher. If you're looking at individual stocks or other products, you can use that in your analysis to determine, where to get out, where to get in, whether to short, whether to buy, whether to stay out of the markets altogether. It's not just limited to futures trading. You can take these same principles and apply it to options as well. You get a rally back up in SPX, buy some put options for a move lower. Same thing with ETFs, in this case IWM. You can buy some put options once prices rally back up into this particular area. It's the same thing as you would be trading futures. Hopefully you guys found this example helpful. It was a pretty good one with all 4 major markets showing weakness, and we were able to capitalize that both in the futures markets and equities and options as well. And let's move on to the next example.